That's exactly what we'll pick up on with Stephen Nash, who's from Fix Securities, and he joins James and I in the studio today. Stephen, the case for a slowing US economy seemed only to be supported by that Beige Book overnight.
Yes, the Beige Book did indicate widespread deceleration in a majority of the districts. However, there was a bit of a silver lining to the Beige Book in the sense that they noted a flurry of refinancing and appraisal work in key districts such as Chicago and New York. Now, as you know, we've had quite a rally in the bond market of late, and that's brought down mortgage rates substantially. I mean, we've had 10-year bonds rally from around 3.25% to around 2.5%. So effectively, these longer mortgage rates have fallen substantially, and there, I suppose, is a feeling that these lower rates are stimulating activity. And we won't see that right now, but we will see that 3 to 6 months' time. So I suppose there's a silver lining there.
I suppose, look, the Beige Book, as most of these sort of economic indicators suggest, is backward-looking. Looking ahead, we've had the President Obama come out earlier this week, the big $50 billion infrastructure spend. We've heard about tax cuts for corporates and also small business. Now, is it going to be enough to get people spending, to get people into the housing market, to get the economy back on track, or is it just, I suppose, a little treat in the lead up to a midterm election?
It's a bit of both. There's a political aspect to this, I imagine, but there's also the important aspect where the market is expecting the administration to avoid a double-dip recession, and they're doing, I suppose, what they need to do right now to do that. And I think what they've done is very positive for the market. It won't have immediate impacts. So we'll probably see this continued deceleration of growth for the next few months, and that could lead, I think, to the equity market getting a little bit more concerned. But we've got this underlying improvement now, I think, partly inspired by lower rates. It's not just mortgage borrowers that are feeling this, it's also corporates that are borrowing at much lower rates than they have ever before.
Are we seeing new issues emerge out of Europe? Obviously, this was a concern yesterday. It kind of went off the radar today, but I imagine it's not going away. Are they new issues, or we've got the same situation as we did 6 weeks ago?
I think it's an old story, yeah, to some extent. There's also some lobbying going on by various banks and countries with regard to the Basel regulation. Now, some of the countries and banks are looking for a less stringent capital requirement, because if the current proposals go through, they'll have to go and raise a lot of capital, and that's expensive for them, and they view that as a negative for growth. There has been some work into that idea by Basel recently, but I imagine that they've already got a substantial softening in the Basel requirements, and that's probably enough for now. Yeah.
Just a quick question, because we want to get onto some of the Australian data. But in terms of where the US economy is at the moment, with the stimulus that we saw, during the GFC and post, and what we're seeing now, is the US economy any better off than it was during the global financial crisis in terms of growth, in terms of unemployment, in terms of those indicators?
Well,
is there any substantial improvement?
Well, unemployment has, as you know, it's a bit of a lagging indicator. It has sort of plateaued. We would expect it, we would have hoped it would have moderated from where it is. The problem has been it hasn't been basically enough growth to do that. With the current measures in place, with the extra quantitative easing and the fiscal stimulus, that will, I think, turn the corner towards the end of the year. So we have to be patient between now and then.
Can we go to the RBA statement, which we've had out just recently as well, on the Australian economy? A couple of key things that you took away from the statement. The reference to "for the time being," which was the subject of a lot of discussion. The moderation in Chinese growth. The reference to the domestic economy being quite balanced compared with 6 months ago. Putting all of that together, did we get clues as to how the RBA feels, or anything surprising in there for you?
I think the underlying biases that were there, people who were going for a tightening are still going for a tightening and are looking at that for the time being statement and saying, well, this is really clear evidence they're going to go next month. And there's the other camp that are looking at the no change. I think within the statement there was a bit of for both camps, but I think generally, that reference to the moderation in Chinese growth is quite significant, because that was a constraint concern going forward. I think that's moderated to some extent, but it really depends on the evolution of the data. I mean, as we know, the bank doesn't follow simple rules. To get too simplistic about it, you're going to miss the point, I think.
Is that moderation a positive, though? Because we know from some of the statements from BHP and Rio when they released their results, they did see that moderation, that decline in growth, but to more sustainable levels.
Yeah. Well, yeah, I think, you're seeing the problems with the Japanese economy, with their export sector. I think the Chinese are experiencing the same problem. The Chinese have acted to reduce or moderate their growth. So I think, yeah, that's positive. But for the Australian economy, runaway Chinese growth is probably not the best situation for us to be in, particularly in terms of monetary policy.
Stephen Nash, I have to leave it there for today. Thank you so much. Appreciate your time. Stephen Nash there from